valuation based upon a lot of estimates. I mean, accounting is a field which is full of estimates, right? You do estimates about inventory, you do estimates about taxation, deferred taxes, many numbers which are actually made up. Goodwill, when you acquire a company, you have goodwill on your balance sheet. Yeah. So there are lots of estimates and it's not an exact number. Then, as I said, no correlation between numbers and market price. I cannot give you a numbers of a company as input and I cannot ask you what is the market price. So there is no correlation. No or little risk management. As I just described, that if something is cheaper at this level, it is a deal at this level, it is a bargain at this level. So when is it that you are going to say that enough is enough? I can't actually lose more, right? So fundamental analysis, it doesn't offer any sort of, they say, I will sell when the fundamentals will deteriorate. But quarterly results, as the name suggests, come once in a quarter, right? And a lot can happen in a quarter. With the kind of tumultuous environment around us these days, economies are going through a shift. And it has always been like that. The one thing that doesn't change about the market is that the markets change. So there is actually no risk management when we truly follow fundamental analysis.
So fundamental analysis is basically leaving some holes in the whole picture. And we are going to use technical analysis to fill those gaps.
Absolutely.
I'm going to show you.
Yeah, perfectly said.
Okay, now this is a good analogy of how to mentally think of return to risk. You can think of digging a hole where you take the dirt that you shovel out of the hole and put it into a pile. Now you can think of the hole as being risk, and you can think of the pile of dirt as being return. Now if you're willing to take more risk, you can dig the hole deeper and put it onto the pile and get higher return. But these two are kind of interchangeable. If you want less risk, you can take away some of the return and put it and lower the risk. So the way you can do that is via leverage. A leverage allows you to adjust the return to whatever level you want, with the understanding that the risk increases commensurately, and vice versa. It allows you to lower the risk by lowering the return commensurately. So these two are kind of they're the same element. You can just turn one into the other. You can get more return by taking more risk. You can lower risk by accepting lower return. Very important to understand that connection. Okay, so now let's look at an example of two managers or two systems, which are seen over time. Now the black, let's call it a system in this case. The black system makes a bit more money at the end of the run here, but the white one has far less volatility. It seems like a lot less risky. Again, the same message here. Even though the black ends up with more, even if all that you were concerned about was return, you still would not choose that approach. Rather, you could double the exposure of the lower risk system or manager, and you would have a higher return with still lower volatility. And you can see that in this picture. So you could just notionalize the lower risk one 2-to-1, and you end up with higher return and still lower volatility. So the point of this whole section of the talk is to get you to understand that it's all about return risk. It's not about return.
So even though you have followed in traders, you need to do periodic monitoring. Okay, that's the solution to that periodic review of your portfolio. So it doesn't mean that you need to do it every hour or every half a day to review your portfolio. You can do it every day to review it for a short while, or every few days. It is fine. So how do you review your portfolio? In the platform, it actually shows you some indicative warning as well. As you can see over here, what CopyPip platform actually highlight is 1.21 times attention. What it meant is that I'm leveraging more than what I have in my account. That means I'm over leveraging. So it is showing this warning. So if I find this, I will refine my portfolio and adjust the settings accordingly. So if I don't do this, if I keep on adding so-called traders or providers to my portfolio, it will become higher and higher in terms of leverage, and that means my portfolio is becoming more and more risky. I'm using more of my capital to trade.
So the second concept before I talk about how to do this is simply that you select markets that are outperforming their competitors. And doing so increases your overall edge. But that raises the tricky question of how you do this. Nowadays, it's actually really quite simple. But we need to come back to this. And I come back to this because it's often difficult to convince people of. In reality, we're faced with, these are the top 20 markets in the world. In reality, whilst we have access to, we might not be able to trade all of these. And I can only speak from my experience here in Australia, in that I'm somewhat limited in that I can trade my domestic market, I can trade Singapore, Hong Kong quite easily through the dealing system I use, and I can trade London quite easily. But the easiest market of all to trade is the New York Stock Exchange and the NASDAQ. And that's probably the same for everyone worldwide.
Now that we come to the end of the first 7 years in sample training, because we use this 7 years data to test the parameters that we want. And now that I'm happy with the parameters, I'm going to test it on the next 4 years from January 2015 to December 2018. Why I do that is because this data has not been used for testing. So if I'm way back if I discover this strategy in 2014, there's no way for me to know whether it will work in future, right? So in this case, at least I can look back and say I make an adjustment from 2018 to 2014. If it works, right, it should work between 2015 to 2018 as well. So this kind of validate the strategy, and not too bad. From a 10,000 account, it's very smooth. You haven't managed to hit any drawdown, major drawdown. It has a net profit about 16%. The maximum drawdown is only 4.49, but just to be aware, this is only 4 years data. If you trade long enough, this maximum drawdown will actually increase. And the win rate is quite consistent, 94.59, still is about 95%. And this is just to give you a fuller picture of what it's like. This is between 2008 to 2014 December, that what we use for in-sample trading, and this period is our sample. So essentially, if you trade in the last 10 years using these parameters, this is roughly what the chart will look like.